Hi, Lee Phillips here. I want to talk to you about some terminology that a lot of people just kind of don't understand. We talk about C corporations. That's a corporate legal structure taxed under Chapter C of the IRS code. Now, the corporate structure taxed under Subchapter S of the IRS code is called a Subchapter S corporation. Corporations are the same. Taxes are different. That's not what we're talking about. We're talking about the double taxation in a C corporation. The problem is when you earn money in a C corporation, basically the only way you can get it out is to pay yourself a wage. And that wage is subject to taxes. Now, the corporation deducts the amount that it pays you as the wage, so it doesn't pay tax on it, but you have to take it into your income and you have to pay income tax on it. So you can get money out of a C corporation by paying a wage. The other way that you can get money out of a C corporation is to pay a dividend. Well, okay, that's fine. When you get the dividend, you pay taxes on it, don't you? I mean, you get your dividends from your investment that you make and you report it every year on your taxes. They give you the tax form and you have to, pay the tax. So where's the double taxation? The double taxation comes in the fact that when the corporation earns all of its money, it shows a profit. It pays tax on that profit because a C corporation is its own taxing entity. It pays taxes. So it pays all the tax on the profit. Then when it distributes the dividend or pays you a dividend, I guess we don't say it distributes a dividend, you pay a dividend. When the dividend is paid, you then have to take that into your income and pay income tax on it. The catch is the corporation did not get a deduction when it paid the dividend. It's already paid tax on all of its profit. From the profit, it pays the dividend. Then you pay the tax again as income when you get the dividend. So it's taxed at the corporate level. It's taxed at the individual level. These guys that run around saying, corporations, none of the money, none of the profits are taxed, that's insane. Because when it actually is paid out as a dividend, they take their chunk off the top here, 30% or whatever it is, and then you pay your 25 or 30%. I mean, it can easily be a 70% tax on the profit that a corporation makes when it actually is paid to the shareholder, the guy who owns part of the company. So that's the double taxation. Profit taxed at corporate level, and then dividend paid, you get to pay income tax on it. So, it's really hard to get money out of a C corporation. Anytime somebody comes to me and they have a small business and they say, oh, I have a C corporation. My accountant told me to have a C corporation. I'm going, why? The only reason you would ever want to be taxed as a C corporation, basically, is if you wanted some fancy benefit plan that was only available to C corporations, and frankly, as a small company, you're not going to do that anyway. So now explain to me exactly why you want a C corporation, because I can get taxes out of an S corporation or an LLC taxed under Subchapter S, or an LLC taxed as a partnership. I can get money out without having to pay it out as a salary, and I can make it come to you as income to you, but deduction to the company, basically. Now, accountant just said I didn't do that right, but there's no double taxation. And we can take money out without paying it out as a salary, so you don't have to pay the Social Security, the FICA, the FUTA, all of that sort of stuff on it. Saves you a fair chunk of money. I've got another video that talks about that. So, double taxation. Hope that explains it a little. This is Lee Phillips. I'm an attorney. Don't hold that against me. In fact, I'm a U.S. Supreme Court counselor.